What's up, world? Michael EJ coming with you another video. Just gonna keep it moving here. Talking about things, different topics, fields of finance, business, and life. Today I'm actually talking to people who are interested in the stock market, or they've been in it in a while, but they're not 100% sure what they're doing, and trying to help them achieve long-term success in the stock market, especially if you want to do better than the market over a long period of time. And the best way to do it is to lean on 4 known ways to beat the market over long stretches of time. It's not going to always work, but 20 years, you'll see it's working. What are those ways of investing, as well as why they're working and what is the best environment. So with that said, let's get started. So I'm going to use the definitions found by Cliff Asness of AQR Capital Management. Huge hedge fund. He's one of my favorite investors. He's the one who kind of opened my eyes beyond the first style of investing, which is the V, value. Everybody loves value investing, man. It's kind of the cornerstone of fundamental investing in general. Looking at a company, understanding the company, seeing that the market has mispriced them, and that mispricing usually comes from a lot of overreactions. Maybe some bad news came out about a company, maybe the outlook for the industry isn't so great, maybe the company had a political scandal or any kind of scandal in general. And the market generally overreacts, sells all the stocks, and now the stock price is lower. Valuation is much lower. This is the way a lot of people like to look at investing, because it's like you're going shopping and you find a sale and you see on the label it's worth $20, but they're selling it to you for $10 because you were there at the right time. I mean, it's the way a lot of famous investors go about things. You have, of course, a man in Omaha, Warren Buffett. You have Ben Graham, you have Seth Klarman, you have Bill Miller. I mean, the list goes on and on of really good value investors. And I mean, how can it not? I mean, it's worked so well. And it definitely works well, the best actually, in a recovering environment where the stock market's probably gone down maybe 10-15%, and the whole entire market maybe overreacts to some news that's going on, or things just look murky for companies. The entire market goes down. The first companies to benefit the most after it hits rock bottom are value stocks. Stocks that are really cheap, maybe relative to their quality of the company, or just in general, they're just really cheap. Those are the first stocks to recover. Now, this is the most popular way of investing, and like I've mentioned, deservedly so. It kind of fits the intuition of maybe going shopping for certain items, maybe for clothes, shoes, whatever. But I'm actually not the hugest fan, not the biggest fan of value investing, for the simple fact that everybody does it. I have a personal belief that if you want to beat the market, you have to think differently than the market. And if everybody's investment philosophy is value, 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 then how can you really stick out? I mean, you can take different angles here and there, but you're not going to do that much better than the market. So I actually focus on the other three styles of investing, and try to incorporate that into my personal process, and hopefully it works out. I mean, I'm just starting the actual investment path myself, so we'll see over time. So speaking of the other 3, let's talk about one of them, M, momentum. My favorite. It is, first of all, it's very different than all the other 3. All the other 3 require you be invested in a stock, maybe for 1, 2, 3, 5 years, 10 years. Momentum, you don't need to do all that. 3 months, 6 months, maybe. The other 3, you're not going to necessarily go with the companies that are growing the fastest, or stock prices are moving the fastest. I mean, the other 3, it takes time for them to play out. Momentum, no. You just ride the stock price up, and then when things start to look kind of shaky, you get out. The reason I like momentum investing the most is actually it's a high hit rate. And what I mean by hit rate is you're more than likely going to choose a stock that will do better than the market. Now, over the long term, these other three ways might do better in terms of absolute success. I mean, but at the same time, these other three, you might have some stocks that do really bad. I mean, you can fall into value traps, both with value and the other ways of beating the market. And in a market like today, where everything's all good, the other three doesn't work. They don't work as well. They just don't work as well. So I'm actually a fan of momentum. It's a different way of looking at the market. It's actually, in a lot of ways, anti-value, looking at companies that are going higher, and just taking a chance, look at the market differently. And a lot of that just comes from just general overconfidence. Both value and momentum, we look at past performance and we think that's what's going to happen in the future. So in value, things look a little murky, and we just expect them to continue to be murky. With momentum, things have been good, and we just expect them to continue to be good. So definitely a on and off switch between the two. Next style is C, Kerry. Now Kerry is a little bit different. To me, it's like management friendliness of a company. Because Kerry is essentially being rewarded for being a shareholder in a company. There's two main ways to be rewarded directly, at least. There's dividends. You hold a company, every quarter you get a check or a deposit into your brokerage account. Just a little bit of cash for investing in a company. Straight there. It's nice. It's a nice feeling. Or you got the other way, which is buybacks, share repurchases. And the way that works and why that's so potent is, let's say, for example, a company has $1 million in profits. And they have 100,000 shares outstanding. And you own one share. So a big measure is earnings per share in the stock market. Now, if that company goes in and buys 10,000 of those 100,000 shares, there's now 90,000 shares outstanding. And if for any reason anybody wants to buy that company, they actually have to kind of bid up the price a little bit, because now there's more earnings per share, there's more value per share. So that's like it's kind of a financial engineering kind of trick to improve a company's stock performance, but it works over the long term. And this is probably the most versatile in terms of environment. In good times, look for companies with a high cash balance and continually buying back their own shares. And in those kind of bad, murky times, really good companies that have a high dividend yield. It's like a different way to view value. Now, speaking of good companies and quality companies, the last style is D, defensive. Now, defensive can be looked in different ways. There's different ways to look at defensive. You can look at it in terms of a company that has higher operating margins or low reinvestment requirements. They don't have to invest that much to get profits. Or companies with low leverage, little to no debt. Or companies with low market risk, low volatility relative to the market, which is defined as a beta below 1. All these different ways. And the best way to explain it is these are safer firms. And it's similar to value and to an extent to Kerry is in that they're overlooked. They're not looked at as much in good times, but when the bad times come, kind of like there's a fight to flight. I mean, there's a flight to quality. I mean, everybody's running to quality names. Everybody's going to Coca-Cola and Walmart and these great companies that, they overlooked them in the bull market, but when you need them the most, all the shares are being bidded up. I mean, that's kind of how it works. That's the best way to explain defensive. So these are 4 different investment styles you can mix and match. A lot of people are value and defensive investors or value and carry investors. I am personally, I'm more of a momentum defensive investor with some carry characteristics in there. Try to blend it in. So yeah, I mean, there's different ways you can mix it up. Who knows? You might hit the holy grail every once in a while and find all 4. I mean, that's kind of the best way, and that's a company you should stay invested in for a very long time. So that's about it for this presentation, for this video. Thank you so much for watching. On this channel, we talk about different topics, mainly relating to finance. I am huge in the stock market. I am huge in viewing different stocks. There's other videos about me talking about my investment process, how I view a stock. And as well as looking more into personal finances. We're gonna talk about that a little bit more in upcoming videos. But yeah, different things in finance, different things in business, and how it all blends into life. So thank you once again for watching. Until next time.